Okay, well, we might kick things off. So hi everyone, Luke Mandekic from Channel Capital here, and thanks for joining us. I'm quite pleased to be sitting down with Charlie Jamieson today, remotely of course, for a bit of a fireside chat regarding absolute return investing in fixed income markets. I guess as you're all aware by now, at the beginning of this year, JCB made its absolute return strategy aptly named the Dynamic Alpha Fund, available to investors as a publicly offered unit trust. When we launched the strategy, we actually expected that it would be more of a story for 2021 and beyond. But clearly the events of this year have really put things into fast forward a bit. And as a result, we've actually been inundated with inbound inquiries about the fund in the last few months. I guess understandably, there's a lot of demand for fixed income products that can generate a reasonable yield without extending out the risk curve at the moment. And so I guess on that basis, we decided to pull together this webinar where we're going to take a slightly different tack. We're really going to drill into the strategy in some detail, hopefully provide everyone with a good understanding around the objectives, the investment universe, how the fund works, how it fits in portfolios, and also, I guess, how it compares to the myriad of other strategies in this space that you've no doubt come across. So, as always, we'll try and keep the presentation pretty punchy. We'll leave some time for Q&A at the end. You can submit your questions in the usual way throughout the presentation using your Zoom tools. But maybe on that note, we'll get stuck into it. So, Charlie, maybe if we just start at the high level, why does absolute return make sense now? I guess is there something about the current environment in particular that makes absolute return more compelling in your view?
I think absolute return, always makes sense to some degree, but clearly after the events of COVID, where everything's been moved into fast forward, in many respects, it probably is very appealing to certain folks right now. I guess in our world, bond incomes have been reduced substantially. In equities, dividend incomes have been reduced substantially. And in cash or term deposits, those return numbers are really mitigated now to the point where it's very difficult to wantingly sit in a term deposit, whereas 5 to 10 years ago they were very appealing. So there's a lot of demand for them. It certainly doesn't change our view of the way that I guess the more heavy beta products will perform and their role inside a portfolio. I still think duration is tremendously important, but we're very sympathetic that a lot of folks probably don't want to be allocated for the first time to duration at these levels, and looking for alternatives in this space, particularly where income has become so difficult to generate and rely upon. We've seen so many of these income type equities that have suffered tremendous capital damage. So the dividend might still be there, but the capital price is whipping around tremendously, and some of these darlings over the years of Telstra and the banks and the like. So these kind of strategies, I think, are going to have a resonate with a lot of investors, and certainly something like our absolute return strategy, which is targeting very low volatility, hopefully will fit a portfolio needs in conjunction with a number of other fixed income offerings that we bring to market. So we now have 4 products in market from our global unhedged strategy, which is quite volatile because of its currency, but very heavily negatively correlated. We only got to look at its performance through March and April to see that thing at one stage this year had 23 or 24% returns year to date. So did a wonderful job of defending and protecting portfolios through our more usual and traditional strategies, global hedged and the domestic fund, of course, and then now absolute return, which is a much lower volatility and possibly lower outcomes portfolio. It's doing well at the moment, but it's going to be seeking different outcomes for portfolios and meeting different needs for investors.
Yeah, and I guess absolute return as a concept is not really new. We've all seen a lot of iterations of absolute return in recent years. Certainly some of them have been more successful than others. Can you maybe just talk through how JCB thinks about absolute return and I guess your philosophy in this space?
Yeah, look, so our philosophy, I mean, we've been waxing lyrical about liquidity and asset quality for, 5+ years now. And I guess in times like we've been through recently, you can really understand why, those scars that I guess so much of the portfolio team and the philosophy of how we've come to that place from the GFC are really borne out for Australian investors. So, suffered some really illiquid periods and some bad lockups with some of these types of funds. I guess traditionally absolute return has given portfolio managers tremendous amount of scope. And what we've tended to find with that is that they use credit in an outsized way and low quality credit or illiquid credit at that. Now that's all fine in a very benign environment. You will earn something. But as we know, and as we've seen brutally, I guess, in March and April, those things are very heavily correlated to, other risk markets. And so from our point of view, we want to offer something which is, again, highly liquid. We can really, promise investors that, we will be able to service their needs and wants as they fall due. I guess, we can prove that from our own business through March and April, where we had tremendous redemption requests from our institutional superannuation clients to buy risk assets or to pre-fund the early release of super. We had no trouble servicing any of that using these types of high-grade instruments. And so absolute return is now looking to you look at that same opportunity space. It's the combination of our global and domestic fund and really just manage to really a volatility outcome for an absolute portfolio outcome. And that's really what it's all about for us. But it's very important that we retain those core elements in our business of high-quality government-only assets with very high liquidity, and then trying to put a return in and around that across the opportunity sets that we find.
Yeah, and so if we turn to the fund itself, I suppose while the Dynamic Alpha Fund is quite new, I think it's important for investors to understand that the strategy is not new, given that it's based off a mandate that you've been running for one of their major institutional clients for a number of years already. And I suppose further to that point, you and the team have really spent your careers prior to JCB managing portfolios in exactly this fashion with a lot of success. Can you talk a bit about your experience managing absolute return strategies, both at JCB and also in your career prior to that, Charlie?
Yeah, so we've been running an institutional mandate in this space since 2018, but and there's a limit to what I can talk to on that from confidentiality clauses, other than to say that it's been very successful and run in this way. But I guess in my prior life, which saw me working in Tokyo, in New York, and then in London for the majority, this is absolutely the style of investing that we used to do. And I guess Coote, with all of her global experience, is another senior PM, deputy CIO, and Chris is another senior PM. A vast array of global experiences managing these types of instruments. So we're very, very comfortable in this space. I guess, my prior career, I only had one job prior to JCB, and it was absolutely managing in this absolute return style for a P&L outcome. And we're running, portfolios in excess of, tens of billions of dollars. And you just don't get to play with that amount of money unless there is some participation and there's very, very stringent risk management. And we'll no doubt get to that as we talk about the way that we do run this fund. But we're really just trying to use our collective experiences through multi-cycle rate cuts, rate hikes. This is our 5th crisis as a management team, starting all the way back from September 11th, GFC, Eurozone, Greek crisis, all of these types of things, to look at the opportunity set in a constructive way, find good fundamental opportunity, with good technical setups, and really, use the same skill sets that we've used for so much of our prior careers to the benefit of absolute return outcomes in this low volatility setting. And so it's really about trying to build a glide path to an outcome and being very patient and very disciplined in a way that we go about to try and achieve that.
Yeah, and so I wouldn't mind narrowing in on some of the detail. And you alluded to this earlier in that I think unconstrained is a term that gets used a lot when talking about absolute return funds. I think it's fair that we can say that JCB is anything but unconstrained. Can you talk through some of the constraints on the funds and I suppose why they exist to begin with?
Yeah, so look, I'll tell you absolutely what we are not, and that is unconstrained. Unconstrained gives managers far too much flexibility, and I think people have had their fingers burnt too many times now with finding out that they have an Argentinian position or something horrific that's gone horribly wrong. In a world where yield is difficult to come by, I guess I'm somewhat sympathetic as to how some managers and investors can end up in those places, but that's not our bread and butter. It's not what we specialise in. So we want to be very constrained in just focusing on primarily the G7 and Australian bond markets, looking at those interest rate curves and trying to optimise a portfolio, for an absolute return outcome. Now, in doing that, we want to be very transparent about the way we go about that, and we want to use really simple instruments so people can understand what we're up to. Now, clearly in some of these products, there can be huge amounts of complexity, whether that's coming in with very complex derivatives or the like. We don't utilise any of that, and so hopefully there is no big surprises with regard to the way that stuff can perform. And I think many other funds have had big surprises through March and April with some of those types of structures. We are fundamentally just investing investors' cash around the world in those big, liquid, highly rated government bond markets and government-related markets, hedging everything back to Australian dollars. So we do need to obviously enter the foreign exchange markets to do that and set up some hedges, but that's actually really simple stuff. And then we use interest rate futures primarily to control interest rate risk or to build particular curve exposures or exposures to particular jurisdictions. So we are very constrained. I guess, from a risk point of view, these are incredibly high quality assets in the biggest and most liquid markets in the world. And so we're thrilled that we can offer this up to the Australian retail marketplace because we believe it can play a really critical portfolio role, but it's really important that it's tightly constrained. And where I guess so many others have had misadventure and by not having that leash on them to just make sure they stay in the laneway that they specialise.
Yeah, and Charlie, I think it's probably fair to say that that JCB has built quite a solid reputation as a specialist duration manager, probably recognised as the preeminent duration manager in Australia. Can you talk us through how duration risk is used and managed within the fund? I suppose given that the fund's not linked to a long duration benchmark to begin with.
Yeah, so I guess part of that constraint is to look at our opportunity set and then just to remove any kind of index holding or index weighting. And rather than solving to an index position and optimizing a portfolio versus an index, we're solving to zero to try and have very little risk. So it's unlikely that this fund is ever going to have material duration positions. And I think, if we look at our other funds, our domestic fund at the moment is running duration of about 7 years. Our global's even a little higher again. And Alpha is at around about 1 year. And that's really kind of roughly where I think it would reside. I don't think it's ever been over 3 years. But in order to seek the volatility outcomes that we want, we need to keep the duration really curtailed. So as a duration specialist, it doesn't mean that we can't use it, but we do need to keep a really tight leash on that with regard to its risk controls. We might run through some examples of the way that we have used that in a moment. But it's important to note that clearly there are lots of duration opportunities. Duration can be more volatile because you are subject to unknown things occurring very quickly. Donald Trump's Twitter account changing the world very quickly. So it can bounce around a little bit. That's why we use duration sparingly in some respects. Obviously, in this instance where we've got a much wider opportunity set and no need to hold a standing risk load, we can explore other things like cross-market positions where we might be overweight a particular jurisdiction versus underweight another jurisdiction. So say we really like the US Treasury market, but we think the German market, for instance, is very expensive. We can build something in like that. We can look at relative valuations in individual curves. If there's a particular point which is very cheap, we can build structures to try and monetize that. Clearly, there are other elements to the fund that we can utilize. We do use a lot of bond basis where we have physical bonds versus a position in interest rate futures contracts which essentially we're trying to lift out the bond income or capture some relationship which will tighten together and we can monetize that in a different way. So I think investors should feel comfortable in here that whilst we are a duration manager, we do use duration pretty sparingly. We will run very low duration positions because we're trying to meet a volatility target, which is much tighter than in our other funds. And so we just simply can't sit on large duration positions because the market volatility that exists in just a natural pricing cycle would give this fund more volatility than we're targeting at this point.
Yeah, great. I think that's a really good overview, Charlie. Maybe if we just drill into some of the detail on that, can you talk through some of the strategies that are used in the fund to generate those returns, and maybe talk through a few live examples?
Yeah, look, I think the best way to think about this is to work out, our starting point. What are we going to build as a holding portfolio which is going to generate some income for the fund? And any of you that have seen us present on our global funds, you will have come across these tables before, which illustrate that, yeah, there's a hell of a lot of negative yielding bonds in the world. Who the hell would want to buy those? Well, it's actually very important which geography you come from as to what those bonds ultimately end up becoming in terms of value. And this is done via the FX hedging markets. And in very simple terms, if you have higher interest rates than another jurisdiction, there is a positive outcome for you as an investor. And so obviously here in Australia, we have pretty low interest rates these days, sadly, at 25 basis points, but we're not as low as, say, Europe at -50. So a really obvious example here for us is something like the German market, which you can see in its local iterations is deeply negative yield. But if you lend Australian dollars and borrow euros and go and buy German bonds and lock all of that in, the expected yield becomes positive. Now, it's not hugely positive, but it's a big transformation nevertheless. And so we're very acutely watching these types of opportunities in order to set up a portfolio which generates carry from around the world. We might just stay on that one if that's okay, Matt. And then we want to use that income to explore some of these alpha opportunities. Now, without getting too technical, the way that the foreign exchange forwards market works is it's constantly moving, as all markets do. But when we get periods of very negative basis, we can lock in even higher yields again. So part of that 1 year of duration that the fund is sitting on at the moment is in 5-year Japanese bonds. And we managed to lock that in with a yield at around about 45 basis points. And you can see in the right-hand table, if you look at Japan, look across to the 5-year column, they're currently at 19 basis points. So we've locked in those incomes at really good levels, and we'll stay with that for a little while until it's time to readjust that foreign exchange hedge. But it's in taking advantage of those opportunities and monitoring this space really closely, as we do with our global fund, that we can generate a portfolio that will bring us some slight amount of income. The income at the moment is up around the 1% level for this fund, so it's pretty slight. Clearly thereafter, knowing that we're going to generate that income, we want to look for alpha opportunities across the G7 and across Australia, where we have very powerful fundamental backing. So, this is all coming out of our singular process as we manage our other funds. Importantly, and we're very lucky to have Chris Manuel as a technical specialist in the team with really good technical setups. So, we believe we've got high, outcomes for risk reward with in terms of entry, in terms of exit of these strategies. And of course, there needs to be some catalyst for why something like this will occur, and why we believe that in a decent time frame, we can put capital to work and explore these alpha opportunities to some hopefully positive outcome. Now, the critical part of this, of course, is in the risk management, because everybody that is an investor knows that sometimes the themes are pretty easy, but the timing is really hard. And particularly when you're looking at markets that are subject to move on headline risk and the like, we can get the themes right and often do, but we don't get the timing right for whatever reason. And it's absolutely imperative that we stop out quickly, because it means that there's a slight amount of capital damage, but it leaves us in a highly repeatable process. Clearly, if we're lucky enough to get the timing right on a good theme, well, then we're going to let that structure run. And then hopefully it'll run to target. It gets constantly reevaluated. And if there's reasons to change our thesis as to how this is going to work, or the world changes for whatever reason, then we'll readjust that constantly, and the portfolio team meet every day in the morning to go through all of these developments and re-examine these positions and these risks. But that's the way that we believe that we can make this a highly repetitive process that can make money when we're getting things right and can control downside outcomes really well when we're not getting it right, because we will stop very quickly and we won't allow material drawdowns to occur. So we do have that standing bond income, and by being really focused on generating that income and finding those good outcomes in the global opportunity set and picking up those nuances that often occur in the foreign exchange market for whatever reason, we can build a portfolio that puts us into that good starting position. And then we need to be very, very patient as to how we find those opportunities. We don't feel obligated. We're not obligated in any way to sit with a risk load, like in the higher beta funds. Clearly, they sit with an asset load. If a plane hits a building, well, then they generally do pretty well. If there's an earthquake in Los Angeles or Tokyo, they generally do pretty well. If COVID-19 comes along, they generally do pretty well. In this instance, absolute return will not sit with that standing risk. So it's going to have different outcomes, and in terms of the way it's going to provide, hopefully, negative correlation by virtue of not going backwards too much. And we've been lucky enough to not go backwards at all so far, which is really pleasing. And with our institutional version of this, we only went backwards three times, I believe, in nearly 2 years, and they were fairly slight in and of that. So it's really about this risk management function, which is so critical. And I guess that's something that we had to learn the hard way in our prior lives. And it really is the kind of special sauce, I guess, that makes this a profitable strategy through time. Clearly, we know governments at the moment are issuing huge amounts of bonds, and there is actually a very alpha-rich environment out there because we have these two enormous but not price-sensitive players in the bond markets. Governments issuing huge amounts of bonds, and then many central banks that are buying all of those bonds back as part of their own QE programs. So it's a wonderful time, and in fact, right across our business, our alpha levels are going up quite dramatically. And clearly in absolute return and dynamic alpha, we're really pleased to be hitting really good numbers on really good risk metrics. And that's really important, I think, when you think about this space. If it is to truly be a diversification for your portfolio, it's critical that those things are well managed. And we spend a lot of time considering all of that.
Yeah, Charlie, I think you had a good example around the recent 30-year issuance in the local market. Do you want to just run us through that one as well? So I think it really does a good job of explaining how you extract opportunities for the fund.
Yeah, look, I guess this one got a lot of press actually. We might get Matt to roll forward a slide. I think we've got a couple of slides for you. But Australia at the back end of July issued a new 30-year bond, a 2051 bond. It was done by syndication. And one of the great things about government issuance is it's actually pretty well pre-telegraphed. So we spend a lot of time thinking about that, thinking about the way that the cash flows of the bond market will work, when people will need to issue bonds, and therefore, you often get a concession from the market when there's very heavy issuance, not too dissimilar to an equity market. If there's a huge amount of new equity script coming, well, the stock price will adjust to make room for that. Versus when the passive participants need to buy these bonds. As they fall into the bond index, in order for them to have very low tracking error or zero tracking error as they seek, they are forced to participate in these markets, which brings a whole series of other outcomes for the market, which we can monetize pretty well. So this new 30-year for Australia was pre-telegraphed. We were expecting it in the third quarter, maybe not quite as quickly as July, but we were certainly expecting it. And so what we're looking at here is the way that the market builds in these big concessions. And so when we're thinking about the shape of a term structure curve, i.e. the difference between a 10-year bond and a 30-year bond yield, all of these global curves have steepened a lot through the COVID period of Q1, but most of the global curves had started to flatten back down, i.e. their 30-year bonds had performed very well, but Australia stayed much steeper. So there was a really latent opportunity there for global investors. We thought this bond would go tremendously well, not because withstanding it's very difficult to buy AAA rated long assets in the world. The only others that were available at this time were Canada, which yielded about 0.9 of 1%, or Germany, which yielded minus 0.11 of a percent, minus 11 basis points. And Australia would come somewhere in the upper echelons of the 180, 190 area, which clearly is incredibly attractive on a relative scale. So there was just, we knew there'd be demand from global asset managers in what was a very steep and cheap curve. I've written about that in some of our monthlies, and it was a really good opportunity for us. So we might just bring forward a slide if we can, Matt, and look at the way that the pricing of this actually occurred. And what we're looking at here, just to make it really simple, is Australian 10-year bond futures contracts. And unsurprisingly, you can see an enormous concession gets made in the bond market, right down to that blue circled area, which is where the bond was priced. And so there's this huge concession, fundamentally cheap securities, with a really good technical setup, given that extension and that concession that's been made. And this all happened on the 29th of July. And we know full well that the passive fund managers need to buy these securities on the 31st of July. And guess what happened next? They absolutely ripped. They performed incredibly well. These things actually rallied nearly 5% in capital terms into that 31st of July pricing. So if you've ever seen an advertisement for why you should not be passively allocated in fixed income, this is nearly the picture perfect advertisement, because everybody that was a passive investor paid 5% more in capital terms for those bonds than we did at new issue. Now in Alpha and in all of our strategies, we were very happy to run long duration coming out of this supply point, but clearly we want to hedge that using futures contracts all the way up as the bond starts to perform to lock in those gains. We have targets. If it wasn't going to work out, clearly we were going to have to stop and add a hedge to shut down the volatility of that. But as it starts to perform, we'll start to sell on the way up, and we'll also lift our stop levels so that we're guaranteed to make money. Now, clearly we have a target that we want to achieve, but we don't hold all of the risk to the target. I think, in surfing parlance, you can't wait to get off the wave when your toes touch the beach. It just doesn't happen that way in markets. I like to readjust our portfolios at lots of different levels rather than wait for one singular level, because unexpected things happen all the time. But this is a really clean example of how we use duration, how we're waiting for these good technical setups with high catalysts. We know that there are guaranteed positive flow of funds that must occur into that index moment. And this is a really good, clean way to make money in the bond market. If you've been doing this for a long time, these types of setups are absolutely what we're waiting for. And when they land in your lap, we have to participate. So we were a very big participant in this issue right across our offerings. And for absolute return for Dynamic Alpha, this did really well through the month of July.
Great. And I just want to turn the conversation to leverage for a moment, because it's a really important concept in this space. I think it's actually an area that's often really misunderstood, and a lot of investors probably don't fully appreciate the extent to which leverage can be and is used in absolute return funds, whether that be through the use of derivatives or other measures. You've always been a big advocate of transparency, Charlie. Can you talk us through how the strategy uses leverage and how you think about this pretty important point?
Yeah, look, we're going to be very transparent about this, but just before we are, there's 2 points to make about leverage. The first is that leverage matters tremendously, but it also matters what type of asset you lever against. So if you lever against a very high quality asset that doesn't move around much and it's not subject to, vast credit, changes and the like, well, that's one type of leverage. Clearly, if you're leveraging against a whole bunch of high yield junk bonds, it's clearly much riskier strategy. So we do deploy up to 2 times net asset leverage in this particular portfolio. But again, we don't use any explicit leverage. Now, let me explain what I mean by that. In terms of explicit leverage, you are borrowing money to buy more physical securities. You can use repurchase agreements in the bond market, where essentially you exchange securities for cash. You can do forward starting transactions where you're not obligated to pay for the transaction until much further down the line. Therefore, you hold the cash that you have, but you can get much larger market exposures. We don't do any of that. We don't short sell anything physically, But what we do is we use interest rate futures contracts, which theoretically generate leverage. So again, looking at that 2051 example that we just looked at with regard to the new issue of the 30-year bond, the most liquid interest rate future for us to use in Australia is a 10-year futures contract. Now, anybody that knows too much about bond markets knows that the longer the bond is generally, the higher its duration or the higher its risk. For each basis point that it moves, it will have a bigger P&L outcome. So in order to hedge to an interest rate neutral point, a 2051 bond, you need more than the notional value of the bond in 10-year futures contracts. Now, the reality of that is that the 10-year futures contract point in the Australian government bond curve and the Australian government 30-year bond have a very, very tight relationship. But theoretically, you need about twice as much of the futures contract to get to an interest rate neutral position. And so that's the way that we use leverage. It's only over on listed futures exchange markets where they are margined daily. We need to post initial margin, but we don't borrow anything to do that. It means that we have a higher exposure theoretically, but the exposures are generally always against a physical asset that will bring the portfolio back into balance. So it's as much a hedging technique for us as it is trying to go off and increase the amounts of exposure in any particular point. Where we can also use it is clearly in those cross-market examples where we want to be, say, overweight or long the US bond market, so we can use US futures and we can use European futures against that to build a short position. Now, that does move around a little bit. We need to risk control that very carefully, but we never take the theoretical exposure beyond 2 times. And that's really important because unlike an equity derivative or an option on an equity, it's also important to remember that bond futures can never go to zero. If they go to zero, you theoretically have infinite yield. Well, I'd like to be an investor in infinite yields, but sadly, I can almost guarantee you perfectly that's never going to happen. So, there are much tighter volatilities in these instruments. Applying a little bit of leverage to a very high quality asset like this really doesn't amp up the risk tremendously, whereas applying a little bit of leverage to something that is already really spicy, well, clearly if it gets spicy in the wrong direction, you can be in trouble very quickly. So we want to be very transparent about that. And the reason for that is that some of the other offerings in this space are not transparent at all about the way they use leverage. If you read their PDS documents, there's no mention of it. But if you look at their audited accounts that they must publish, it's always on page 80 or page 90. You've probably fallen asleep by then. They are very leveraged, and some of them, more than 10 times leveraged. So this is an important point. You'll certainly see some of them did not do well through March and April when a lot of these relationships break down and the deleveraging occurs. And you've only got to look at their performance numbers and their drawdowns to probably work out who I'm talking about. But we want to be very transparent about the way that we do use this. Clearly, in order to build the portfolios that we want to meet the return targets that we're trying to hit, this is necessary, but we're not overextending on this by any means, and we don't believe it's something that you should really fear at all. As long as that risk control is there and if everything's margined, it's actually very tightly controlled and optimizes the outcomes nicely. Yeah.
I think that's a really good segue into the concept of around risk management, which is critically important in this space, obviously. Can you just touch on some of the risks that are involved with an absolute return fund, such as the Dynamic Alpha Fund, and I suppose how do you seek to control and mitigate those risks through time?
Yeah, look, clearly, I mean, in any space where managers have, more flex, that there is clearly risk in the management team, no doubt. But when we look beyond that, assuming that you believe that we're okay at this, and I guess by virtue of our prior careers, we hope that you would agree with that and what we've achieved in our business to date. We've got fantastic risk-adjusted outcomes across those index relative strategies, but the risks are really quite slight. We are using very, very high-quality instruments, government-backed around the world from very high-quality governments in very liquid markets. Clearly, as we're being very honest and transparent about, yes, there is some risk associated around interest rate futures, but that optimizes the outcomes. It's as much a risk management tool as it is risk seeking. So they really are slight, and we firmly believe that this can meet a particular investor need in a world where I guess term deposits and the like are now very low. Of course, we can't make any guarantees about the performance of this fund, but we do believe that, unlike a term deposit where only $250,000 is guaranteed by a bank, with something like this, we own explicit guarantees from government. And that's quite a difference. So the underlying assets are very high quality. We are only long those assets. We don't short sell them as much as we can put interest rate futures around them. Those relationships are actually very tight relationships. They don't really go walkabout by tremendous amounts because one is clearly very highly related to the other. So we believe it is a fairly low risk fund, but it is that risk management which makes it hopefully be able to achieve what it wants to achieve. And we'll be very, very stringent on that. I think, our risk management history in our domestic fund, which has got the longest time frame, we've had something like 23 monthly drawdowns since we've been running that fund. We've outperformed 22 of them. So we've only ever had one miss in terms of controlling that risk, seeing that there is some decay in front of us and moving to a neutralized position or a position to protect capital. And we unashamedly do that in this fund because we don't need to be invested all the time. It's waiting to find those really powerful, very high conviction opportunities and then looking to explore them, but using hard stops on entry so that that risk management kicks in very quickly if we are to get the timing wrong for whatever reason.
Yeah, fantastic. And maybe just one final question from me. I want to touch on portfolio construction because it's a question that we get all the time from our investors. Can you maybe just talk through where you see a strategy like the Dynamic Alpha Fund sitting in a broader portfolio context? I guess a lot of people have very different views on this point, but do you see it as being a replacement for traditional long duration fixed income? Does it form part of a cash bucket? Should it be considered an alternative, or is it something else entirely?
Yeah, look, I think, everybody will have a different opinion on this. I still very firmly believe that long duration strategies will continue to do well. And I'll take you all the way back to, maybe don't change the slides, Matt, but slide number 4 shows that many markets around the world, when they've been at low yields or even negative yields, still generate good positive total returns. And I fully appreciate that that's a difficult concept to get your head around, but bonds have really not been about the standing income for quite some time. They've been low for a long time, but they're still powering ahead, doing a wonderful job of providing that defend and protect with much higher negative correlation outcomes. So for mine, I think this is in conjunction with those types of holdings. We've been very explicit about saying that we don't think credit is an optimization to an already equity-heavy portfolio. Clearly, if you only own government bonds, you should have lots of credit. But if you own lots and lots of equities, you shouldn't have much credit because you already have credit in the equity. But everybody will have their own opinion about that. The very obvious ones, and the way that a lot of the institutional investors are looking at that, is clearly out of that cash bucket and out of defensive alternatives. And I think where this one is a little different is it doesn't take a lot of time to have a good outcome, whereas in the more beta-heavy strategies, if you're unlucky enough to invest on the wrong day and the bond market does sell off a little, you go into a drawdown quickly and you've got to take time to come back in that. As we know, it's a very, very self-correcting product. But with Alpha, hopefully we're not going to have those drawdowns. We're trying to mitigate that as best we can. Of course, we will have some drawdowns over time, but we really do try and run that as tightly as possible. So, yeah, I think it can work absolutely in conjunction with, particularly at a time, as I said early on, incomes are low, cash is very low returning and locks you up, gives you bank risk, without liquidity, a very, very slight outcomes. Dividend yield is low or is getting withdrawn, or there's capital damage in those types of instruments. So here we're looking for something that we're trying to hold capital stability. Clearly that's paramount. Provide income where we can, and good outcomes on low volatility, so it's not too much of a bumpy ride. And I'll leave it up to to advisors and to investors to make of what they will. But clearly this is a process that we've been using for a long, long time. With tremendous success over time, and now we're excited to bring it and make it available to Australian retail investors at this point, where I guess that income challenge has never been more complicated, and we really want to do that in a really high quality way, where you're not forced to take on tremendous amounts of credit risk in order to find that little bit of income that you seek. So I think, we know that compensation for those credit risks has never been worse. And we still believe there's a big insolvency phase coming once we come off these very generous government subsidy programs. So, being in very high quality assets like this is pretty sensible in my eyes, but, it's up for everybody to make their own conclusions on that.
Excellent. All right, thanks for that, Charlie. So just before I open up to Q&A, I just want to touch on one final slide quite briefly. Maybe I just want to flip forward a few slides. Okay, so what we've done here is we've just pulled together a list of all the strategies that we could find which fit into the kind of broad absolute return fixed income category. As you can see, the list is very long, and I'm sure we've probably missed a few in there as well. And I'll actually go out on a limb and suggest that you're going to very likely see a lot more strategies popping up in coming months and years in this space. Interestingly, the cohort here is super diverse, right? So there's a lot of very different approaches and philosophies across managers in this space, and this absolutely shows up in the outcomes. So the data that we've shown in the tables here is from the inception of the JCB fund, which was in January this year. So granted, that's quite a short period in absolute terms, but it's obviously a very important period of time given what we've been through this year, and I think that the numbers warrant some attention. Charlie spoke a lot about risk management in the presentation already, and the unconstrained nature of some of these strategies and the fact that there's a lot of leeway allowed. It's these sorts of environments where you kind of find out who's been, simply extracting some sort of risk premium, whether that be through credit, rates, or, using a lot of leverage, or looking for illiquidity or something like that to generate returns. It's periods like this where that can really come unstuck. So there's a lot of data on the page there, but I just want to get you to cast your eyes to two areas in particular. On the right-hand side of the slide, there's a column with some risk metrics. Firstly, if you have a look at the column marked standard deviation or volatility, just run your eyes down the list there. The dispersion in annualized vol numbers over the calendar year has been absolutely extraordinary. I mean, to see absolute return fixed income managers producing vol north of 12% is pretty incredible. Remember, these are strategies that have been marketed and designed as being defensive and being a defensive alternative for portfolios. If you look at one other column on that chart, the max drawdown column, again, I think some of the drawdowns that we've seen are pretty alarming. So having drawdowns of a lot of managers in the double-digit space, one out to 18% was the peak to trough drawdown. I think in mid-March. So this is looking at daily returns data, which I think is super important in a space where people are coming into these funds for daily liquidity. There were a lot of really big intra-month drawdowns, and again, this is not really what you should expect to experience in a fund like this. We've been really proud of not only the returns that JCB have delivered over time through their Dynamic Alpha Fund, but more importantly, the way that it's been delivered. So they've absolutely delivered on the risk characteristics that they've set out to deliver, and we think that's of absolute importance in this part of portfolios. So I'll leave it at that, and we'll open up to Q&A now. So the first question that's come through is from Adam. Adam's just asking, Charlie, can you explain how much FX is used in the portfolio and how much that has contributed to returns over the journey so far?
It's a great question because clearly a lot of these absolute return managers rely heavily on the FX lever and often emerging market FX at that. That is not our specialty. As much as we are investing in G7 bonds, which require FX transactions, we are nearly always fully hedged. Now, clearly, Chris, as I said, has got a very good technical capability, being a CMC chart holder. That's like a 3-year degree in technical analysis. Sometimes when we're setting those trades, we might leave a little trail, but a very slight trail that would re-hedge. Not dissimilar to the way that I showed you the 2051's example, where we would have very strict stop loss limits, but we believe that we could potentially monetize a small piece. But the reality of it is FX is never going to be a primary driver of this fund. We need to be involved in the FX markets, and most of that is hedged back to Australian dollars to 100% ratio. When you look through the PDS, portfolio possibilities and, the breadth of the mandates, it's important to remember that they're always set far wider than we could ever envisage actually going, because these strategies need to last for, 50 years plus, hopefully. And so, in there we've got listings of things like, Chinese bonds and the like. We will never invest in Chinese bonds. It's been in our global fund as a possible investment in 2018 without writing about that well ahead of time. But I can't sit here and tell you that in the year 2040, we might be invested in Chinese bonds, and we need to put that into the mandate now in order to be able to do that without having to go back to what is hopefully lots and lots of unit class holders and ask their ability to do that. So we nearly always hedge to 100% hedged outcomes, and FX is not a driver at all. We really are, our core competency and specialty is in bond market and interest rate management and finding those opportunities around the world. As I said earlier, we have tremendous global experience in doing this as an investment team, and it is a very alpha-rich environment at the moment. And we really want to focus on that core competency so that we can deliver what we've predestined and telegraphed to you guys that we want to deliver on in a volatility the way that we want to do it. And actually, that's another good point. If we were using FX, we would bring much more volatility to the fund that we're not seeking. We want to have a really tight, low drawdown type fund offering, and that's another reason why we've just got to make sure that the FX is hedged really tightly or very stringently controlled if there is a small tail risk of FX exposure.
Great. And there's another question here, which I think is a really good one, and I expected this to come up. So the question from Paul, who asks, I've been using the JCB Active Fund as the most defensive element in my clients' portfolios. Should I be swapping this out with the Dynamic Bond Fund, given that capital preservation is the key goal here?
Look, that really comes down to, what your view is of what the allocation is there to provide. If it's just about returning some slight amount of income over time, and it doesn't need to play another role in diversifying riskier assets or controlling volatility across the portfolio because of the high negative correlations in something like the CCJCB domestic fund, well then, yeah, you could potentially consider that, absolutely. I firmly believe that as a standing start portfolios do need to own duration for those unexpected moments. As I keep saying it until I'm black and blue in the face, there was a time last year when the Switzerland market had a nearly positive 15% year-to-date outcome, whilst its bonds yielded negative 1.1%. In terms of total return outcomes, when duration is needed, and it was needed then, these things still perform even at deeply negative yields. So I don't want to cash in on that, because if that's the way that your portfolio needs to behave in those moments, then I can't guarantee you that absolute return will be anything like that. So it's really a question for you to answer as to what role does fixed income play in your portfolio. Clearly, I firmly believe in the beta through time. It will continue to do well, and we write, constantly. We're not predicting it, we're observing it. And Australia is just a little later to the party with a much cheaper bond market and a much steeper curve, so the party can go on here for much longer than we've seen it go on in other jurisdictions. But yeah, I can't tell you that it won't come with some volatility. We had a little bit of a sell-off in bond markets this month, although they're rallying back quite hard now. That's really something that you're going to have to answer for yourself, depending on what you want the allocation to be in your portfolio.
Yeah, and just on that point, Charlie, I think in terms of the downside risk, the likelihood of a sustained drawdown from the long duration funds is still probably quite minuscule, right? Given you've got a RBA anchoring the curve and non-existent inflation. Any thoughts on downside at this point in time?
Look, we know the high-grade government bond markets are tremendously self-correcting. So even when they do have a little bit of a wobble, they tend to come back very quickly. For anybody that is interested in this, there is a great piece done by Bank of America in 2016 when we were at very low bond yields, looking at what would happen to bond yields if they turned around and rose for 30 years as they'd roughly fallen. And the net outcome of that is that Australian government bonds would return a 700% return because the incomes start to compound on themselves very quickly. So as much as there is initial capital damage, you've got to remember that this is quite extraordinary to government bonds because corporations go bankrupt once you put them through that level of funding stress. Now that's not going to happen because all of us will be paying 95 cents in the dollar in tax in order to satisfy the debt loads that we have in this day and age. If yields are to go up like that and governments are forced to pay the interest bill, I can almost certainly tell you that won't occur. But yeah, the beta heavy solutions are there to play a role, particularly in unexpected times, and they're going to play that role well. It's very unlikely they're going to have material setbacks in our opinion because the RBA are telling us explicitly that they are going to anchor interest rates here. And in many respects, bonds are actually very cheap versus the RBA cash rate. But it comes with different volatility metrics. And so it's really up to you to decide what you're looking to seek in all of that.
Great. I know we're kind of running over time here, but I just want to get one more question in because it probably follows on from the last one quite neatly. So the question from Jake is, where do you have your personal money at the moment across the funds that JCB offers?
So personally, I'm invested in our domestic fund, and I've been there since the beginning. I'm invested in our global unhedged fund, and I'm invested in the Dynamic Alpha Fund. And all of those are at slightly different weightings, but I believe they all have a very good role to play. I still very much like the unhedged fund as an offensive allocation in many respects, as much as it's gone under a bit of sufferance as the currency is rallying back, but that won't last forever. But yeah, very happy to be in this space for a low volatility kind of outcome and looking, for those low but incremental returns. I fully believe that this sits very complementarily next to those high duration loads and builds a really good fixed income portfolio without taking on undue credit risk at very low compensations.
Great. All right. Well, thanks Charlie, and thanks everyone for tuning in. We will send around a copy of the full slide pack to you all. There'll also be a replay of the presentation made available in the next few days. Apologies, there's a few questions there that we didn't get to this afternoon, but we'll come back to you guys individually. And if anyone would like any more information on the fund, platform availability, all that sort of stuff, please get in touch with your relationship manager. Details up on the screen there. We'll be happy to help you out. Thanks again, everyone. Thanks for your interest, and hopefully we'll speak soon.
Thanks a lot, guys.